You're watching today's Daily Market Comment by Mario Sajigiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Investors' concerns around China's economic trajectory reached a crescendo this week, hammering the offshore yuan down to new record lows as capital outflows escalated. At the core of China's problems lies a property sector bubble that has burst. Insufficient stimulus to counteract the fallout and the economy's suffocating lockdowns allowed this crisis to snowball, raising the risk it infects the nation's leveraged banking system that is highly exposed to property loans, with rising interest rates globally amplifying the funding stress. Without any signs the landscape is improving, it is no surprise that Chinese equity markets are under heavy pressure and the offshore yuan is brushing record lows. The twist is that unlike Japan and Europe, a weaker currency is beneficial for China since the nation still enjoys a massive trade surplus and muted price pressures, allowing FX depreciation to boost growth and inflation. All told, China is perhaps the greatest risk for the global economy. While the United States, and to a lesser extent Europe, are likely to face vanilla recessions, China might encounter something much more worse as the property meltdown can ignite systemic risks. Currencies of economies that depend on Chinese demand to absorb their commodity exports struggled yesterday, with the prime examples being the Australian and New Zealand dollars. In the United States, a batch of soft PMIs dealt a minor blow to the dollar. With the Fed hell-bent on rolling out more rate hikes while business surveys are already at contractionary levels and sinking, there's a growing sense the speed of this tightening cycle will be a terrible policy error in hindsight. As for the dollar, while the picture remains positive, we might be entering the final act of this ferocious rally. The Fed has opened the door for a slowdown in December, the market is flush with long dollar bets, and the outlook for the euro has turned incrementally brighter after the massive decline in energy prices. Hence, the fundamentals still favor a stronger dollar, but the runaway for further gains seems narrow. Bad news for the U.S. economy was once again beneficial for Wall Street, with the S&P 500 rising more than 1% after the disappointing batch of business surveys fueled hopes of a more cautious Fed. The earnings season will kick into top gear today with heavyweights such as Microsoft, Google, Visa, and Coca-Cola releasing their quarterly results. The problem with this reporting season is that no matter how good of a quarter a company had, it cannot say confidently it will sustain that performance given the shifting macroeconomic outlook. Hence, any earnings-driven rallies are unlikely to be sustained for long. This was a Daily Market Comment. Thank you for joining us at XM.com.